the last 19 months have been particularly robust. Obviously, with banks, I think we're in at least 9 of the biggest 11 deals. I know for a fact we've been involved with those on the banking side, and we've also represented Adelaide Mortgage on some of their transactions on the mortgage REIT side, and we've been involved in fintech. We've obviously got both the Blackhawk deal private to Silver Lake, which was a great deal for them and for the Blackhawk shareholders. And then we recently just closed Financial Engines, and Hillman Friedman bought them. So both on all areas of financials, whether it's fintech, REITs, or banks themselves, we have been active, and I hope it continues. It seems like people right now are focusing on the higher interest rates, that it's just on the deposit side, and that the higher cost to banks. The reality of it is there's two sides to that equation. And what I think people should more focus on is what's happening to the net interest margins, which are expanding. And with the new tax benefits really starting to take hold, you're seeing ROAs, return on assets, increasing 10 to 15%, which is formidable. So I think there's clear sailing for a little while, and I think the financials are going to be in good shape, and there's certainly a lot of private equity money that's looking very closely at all, in fintech space, which is going to become more and more prominent.
Jamie Dimon talks today about rates should be at 4%. Maybe they get to 5%. What makes sense to you right now when you look at interest rates and where you think they will be going in perhaps the very near future? Well,
I agree that interest rates need to be higher. So there's two things: is where should they be if everything was just done empirically and correctly, versus where are the outside influences? Where will they get to? I think it's easy to say that they could be between 4.5 to 5.5, based on the strength of the economy and every other element. I do feel that we have a different situation in Washington, and we have a Fed chairman that probably will not be as hawkish as maybe he could have been, and I think there'll be some influence to keep rates lower artificially, which is what we've been basically doing for the last decade. I wish that weren't the case, but it's hard for me to imagine them going up that quickly. I think they will go up, but I think it'll be in a slower pace than what probably should have happened. And, I've said that for 3 or 4 or 5 years now. But the economy is real strong, so I don't know why there's an aversion to let rates go up a little bit and find a more natural level, rather than this sort of fake benefit that we've been getting for a long time.
Yeah. You have people who've been weighing in, Jimmy, on where they think we are, what inning, so to speak, of the bull market. We could put it in golf terms to make it easier. If the bull market's a round of golf, what hole are we on? We've probably gone through the turn, but where are we?
Yeah, probably the same we are with my life. I think we're probably, and I hope we're probably around 13. Not so we're into the back 9. But I think maybe my life I'm hoping we're 13. But I think we could be closer to 14. But I think the next 18 months will be pretty clear sailing. But the economy, it's interesting. If you look at financials and look at tech stocks, they're acting much worse than what the economy is really doing. And if you really talk to people that are out there, it's pretty strong, and it'll go for a while. So maybe we're on the 13th hole, Scott.
All right, so we still have some room to go. A lot of things can happen. I've got a panel in front of me, Jimmy. I know people want to ask you some questions. Steve Weiss is sitting to my right. Steve?
Hey, Jimmy, good luck, and I'm jealous.
Appreciate it. I'm thrilled.
If you need a caddy, Scott's always available.
I got a University of Oregon boy going with me. He's going to take me all around that golf course.
That's great. In terms of the M&A, we see so much M&A, of course, of the big names you're involved in. You're also involved in a lot of small names. It just seems like an endless stream of savings and loans and just smaller community banks merging. So what you're going to have, I think, and you tell me if I'm wrong, is that this void created between the big banks and the regional banks, and then the small banks. So how do you play that? You play that through fintech, or do you play it through increasing market share in the regionals?
Well, that's a very good question. You know, fintech is going to have a bigger and broader impact for a long time to come. It's harder to play because obviously it isn't sort of as simple as bank stocks. I always felt with bank stocks you find, you know, good management teams that are well capitalized, and the closer they are to sort of book and a quarter, book and a half, you buy them, and as they get to 3 times book, you start to think about lightening up a little bit. Fintech, it'll be a different dynamic. The reality is there has been an endless stream of deals, and that's what, you know, if you read, everybody sort of talks about now that with the sort of what they're feeling of decreased regulation, that you're going to see this whole massive amount of deals. That's not going to happen. There are probably 7,400 banks in the country. 6,000 are under $1 billion. So there aren't as many potential combinations as people think. Now, will there be some of sort of the 10 and the $20 billion deals, asset size being done? Absolutely. But recently, the market hasn't been amazingly receptive to deals. That's number one. And, you know, there aren't as many real buyers as people think. So to answer your question, I think I really believe the days of banks being sold and not bought are over. I think banks are now bought and not sold. By that I mean there's not a lot of money in speculation as to who's going to be acquired. What you really want to do is find the good acquirers that will pay reasonable prices and do deals that will make sense. And while you don't get that initial big pop, so to speak, over time you'll get that, you know, 110 on assets, 15, 16% on equity, or even maybe 12, 13% on equity, and that's the way to better play that, rather than trying to speculate and pick what companies are going to be sold, because there's not going to be real big premium deals done, and if there are, the buyer will have to, will lose money the first day anyway, so that most of that premium will be gone. So I would look more at the potential acquirers and who can do a good job with that.